You are listening to Mining Stock Education.
The segregation between winners and losers will be the segregation between those people who can use AI to create value and those who can't. I will be a winner.
It's Mining Stock Education. I'm Bill Powers, your host, and in today's show, you're going to hear from the one and only Rick Rule. Doesn't need an introduction. Along with myself, you'll be able to glean from his half-century of investing in small junior resource stocks. Rick, thanks for coming back on the show. Something I've been studying a lot is machine learning or large language models, artificial intelligence, and how that is going to affect business and society. Do you have any insights on how you see this infecting junior resource companies and investing in junior resource companies?
I think it'll be a superb tool for those people who learn how to use it. Investment analysis, which is what I do, involves understanding how to ask the right questions and understanding the process by which we derive answers. Before we went on the air, I talked about how in the 1970s and 1980s, comparative analysis between peer companies would take me personally as much as 6 weeks. Taking apart 5 years of annual reports, quarterly reports, putting them on a conference table. Bloomberg automated that process for me. And what had taken me 6 months began to take 7 or 8 or 9 hours. Extremely efficient. My belief is 2 years from now with AI, I'll be able to accomplish that same circumstance using Grok or some other tool in 15 or 20 minutes. Were I an assembler of information, somebody who did as opposed to thought, somebody who was responsible for pulling paper clips out of annual reports, I would have been put out of business by Bloomberg. But for people who understand how to use information to solve problems that make other people money, AI is just a continuation, of automation. The continuation of the application of technology to make human effort more efficient. It will, like all technology, exacerbate the differences between creators and consumers. It will make the distribution of rewards more uneven than the distribution of rewards is today. The way that you defend yourself is to understand how to add value. Understand how to ask questions that will deliver valuable conclusions and how to deliver the value from those conclusions to people who will pay you for it. The segregation between winners and losers will be the segregation between those people who can use AI to create value and those who can't. I will be a winner.
Rick, if Grok or Google's Gemini or OpenAI, if they scrub the internet of every Rick Rule interview that's out there and gather all your thoughts and put that into their large language model, would that system, though, be able to understand all the nuances of investing in junior resources and the due diligence points to look at, as effectively as you as a human?
5 years from now, yes. 5 years from now, yes. What will be a challenge for AI, I think, will be to understand enough about the answers that you get in the context of the psychology and the competence of the person that you ask the question about to make it useful. I know, as an example, that if I have a question that involves some subtlety around geology, grassroots geology, in tertiary volcanics in accreted terrain, in the Western Canadian Sedimentary Basin or the Chilean Cordillera, I can go to Brent Cook. And Brent Cook has an instinctive knowledge of that geology. And so I will accord his answer a higher probability of success than I will going through the same line of questioning with a geologist whose expertise is in the Canadian Shield, in 2-billion-year-old rock. Will AI develop the sophistication to look at the track record of the person who they are asking the question of and assign relative probabilities to their expertise? I don't know the answer to that. I don't need to know the answer to that because I will still be involved in that part of it myself, around macrogeology, the drudge work around the difference in fiscal terms between, say, Chile and Mexico, to figure out the weighted average cost of capital in a company using the variables that I choose rather than using the variables Wall Street chooses. In other words, the really sophisticated stuff that I do that requires my own knowledge in acquisition gathering will still, at least in my lifetime, be proprietary. What won't be proprietary is the ability to cut through centuries of drudge work around data.
So, Rick, there are these publicly traded on the TSXV merchant banks or investment banks. And when I look at their net asset value of assets under management versus what their market cap is, there is such a stark difference. Now, you were running a fee-based business. Why do these investment banks go public? What's the value add, if any, to investors when they trade at such a discount to net asset value? Why that discount?
What happens is that the discount either does or does not go away over time. What gets in the way of most investors, and by the way, most merchant banks, is time. Most investors, they might be investing in a strategy that has a 5-year fuse, utilize tactics with a 3-month fuse. And the juxtaposition of a 5-year strategy and a 3-month tactic guarantees failure. I look back at Dundee Bancorp, going way back, to understanding as a mentor and a customer and a competitor of mine, Ned Goodman. Dundee Bancorp was spun out of International Corona when Corona was sold to Homestake. And the people who owned Corona were doing it because there was a transaction. They didn't care about merchant bank, and particularly institutional investors didn't want to own a competitor who was likely to outcompete and embarrass them. And International Corona didn't do much, Dundee Bancorp didn't do much. In fact, it went down after the spinoff. I think the ascribed value was $1.10. It fell to 42 cents, if my memory serves me correctly, maybe 50 cents. But over time, the specialized knowledge that Ned Goodman had, the value add that he could deliver, which had already been demonstrated in the Hemlo transaction, meant that the stock went from 50 cents to $40 in the 6 or 7 year time frame. Most investors won't give it 6 or 7 years. Most investors expect the gap between net asset value and price to be resolved in 3 months. Most people think because 3 months is a relevant time frame to them, that it meets their time expectation, that it's real. And it's not.
Okay.
It's a figment of their imagination.
So in light of that, when you look over your last half century of investing in junior resource stocks and speculating, the mistakes that you see speculators make, is it primarily due to feed, greed, or impatience, what you're describing there? Like if it's a trinary decision, you could only choose one of those, where do most mistakes come from?
Time and greed. Most people believe that if they want to believe something, it's true. And that's wrong. Most resource juniors, the vast majority, 90%, are valueless. So if you assign any value to them whatsoever, you're making a valuation mistake of 100%. That's hard for people. Most people buy penny dreadfuls because they want a 10 to 1. And most people don't want to invest the effort required to see if their expectations are real. Most people will not examine the track record of the CEO, or beyond that, the chairman of the board, or beyond that, the CFO, or beyond that, the explorationists. Most people hear a story on a podcast or from a newsletter, and they follow the old dictum, got a hunch, bet a bunch. That's wrong. You neglected a fourth category, which is laziness. Most investors won't do the work necessary to achieve the success that they hope to enjoy. If they do the work, I know some that have done the work, then there's a mismatch between their patience and the time that's required for their narrative to play off. Bill, I've graded, by some estimates, over 100,000 portfolios in 30 years of grading portfolios. I've taught a lot and I've learned a lot. I've learned about what investors get right and what investors get wrong. The Buffett dictum that he became rich by being brave when others were afraid and afraid when others are brave, 90% of society gets it wrong. They get their emotional succor from the market, which is to say they're brave when they ought to be afraid, and they're afraid when they ought to be brave. You and I started interviewing each other when uranium wasn't merely boring to people, it was terrifying to people. Beyond that, they hated
$16 a pound, Rick. $16 a pound. Yeah.
They hated it. They were afraid when they should have been brave. We would talk, you and I, on your show, that the incentive price for uranium was $60 a pound. And if the price didn't go from $16 to $60, that the lights would go out. That's what was going to happen. You had a reasonable number of listeners even then, probably 10,000. I bet you not 100 acted. When the price of uranium went through $60, when it didn't have to go up, when the prices of all the stocks were up fivefold, if we told that same story to 10,000 people, probably 3,000 would act. When the price had to go up, nobody gave a shit. When the price didn't have to go up, the price action that they'd already seen justified the narrative, even though the escalation in share prices took away the incentive to act on the narrative. Most people are afraid when they should be brave, and most people are brave when they should be afraid. Even me, Bill, 50 years. You go back to COVID time. Nobody's traveling. Nobody's buying oil. So the price of oil declines. Concurrent with that, they kick Exxon out of the Dow 30, replacing it with Salesforce. Now, I've taught myself to look for unsustainable circumstances, and I've taught myself to look for one-off events that depress a share price that aren't going to continue. How many times can Exxon get kicked off the Dow 30? One, right? It occurred. I know that $20 oil is not sustainable, that we need $60 oil or people's cars won't start. And did I buy Exxon when it got kicked out of the Dow 30? No. I thought it could go lower. Sometimes stuff is cheap enough. How dumb can you get than having been trained for one event for 40 years, and when the circumstances, the coalition of circumstances that you've trained your whole life to act on occurs, and you say, it could get cheaper. Dumb. So while I criticize others, I exhibit this behavior myself on occasion.
So what feedback loop do you have in your own life to help you with that?
I've taught myself that sometimes stuff is cheap enough. Sometimes stuff is cheap enough. The oil price right now is dipped below 60. It's dipped below the 60 handle. It's dipped below the 60 handle, not because of overproduction, which is what the world thinks. It's dipped below the 60 handle because we're probably coming into a recession. There's slowed economic activity. Could the oil price go lower? Absolutely. Is $60 a sustainable price? Absolutely not. The oil companies, the best oil companies, the Exxons of the world, make a lot of money at $60. So I'm starting to buy them. Could oil go to 50? Absolutely. Could it go to 40 in a recession? Absolutely. Will oil be at $40 5 years from now? Absolutely not. Buying Exxon today, will I be happy in a year? I don't know. Will I be happy in 5 years? Nope. I'll be ecstatic.
With Rick, with that feedback loop, self-imposed feedback loop of it's cheap enough, does that apply to Exxon, companies that are producing with cash flow that pays a dividend? And does that apply to smaller companies down the food chain? Like, how do you apply that at the size company?
Yes, but they're rarer. and the circumstances change more rapidly. I know of a very high quality micro cap exploration stock right now that is selling at about a $12 million Canadian market cap, that has $18 million in current assets and has a spectacular exploration portfolio. The company's selling at a discount to cash. Two things. If I buy a bunch of it, all of a sudden, it won't be selling at a discount to cash. I'll move it myself. So I have to buy it very carefully. But I also have to watch what they do with the cash. Cash turns out to be a fungible asset. And if my reason to own the stock is because they're selling at a discount to cash, I need to make sure that as the cash declines, that they are spending that cash on assets where the asset values are increasing. You don't need that level of scrutiny with Exxon. You have 30 years of a track record of superb allocation of capital. You have a business advantage and a range of assets where you have durable competitive advantage over time. You don't have that in the smaller companies.
Okay, well, I'm thinking in terms of valuation as you talk and are referencing what we talked about earlier about artificial intelligence. Does artificial intelligence, you said those that know how to use it are going to make money and rise to the top. So there'll be a bigger gap between those that know and those that don't, okay?
Yep.
Does this make the market more inefficient, or will it ultimately make the market more efficient?
Or inefficient.
Could you elaborate?
Most people that run companies won't be sufficiently versed in adding value that they use AI for what it's worth. In other words, maybe 10% of the companies, probably the best 10% of the companies now, will understand how to use AI to make what they do more efficient. Bill, we think of ourselves as a society as rational human beings, ones who search the whole universe for information and weigh that information rationally to make investment decisions. That's wrong. We are passionate and prejudiced human beings who search for information that reinforces our existing paradigms and prejudices. Most investors who've made up their mind on a stock, who get information about the stock that's negative, if they're in a bullish mood that day, ignore that bad information to reinforce the prejudice that they already have with regards to that stock. You need to be intellectually and psychologically prepared to use any tool, including AI. Knowing that, as well as I do, being as disciplined as I am, working as hard as I do, I'm still going to screw it up every 18 months. I'm going to do it.
Mm-hmm. How do you think it impacts the brokerage industry?
The brokerage industry needs to be disrupted. It really truly needs to be disrupted. I want you to think, Bill, about every aspect of human endeavor. And I want you to think of it in the context of Pareto's law, the social science dictum that says that 80% of the utility in any given application is delivered by 20% of the population. And then think about that dictum in its whole, the bell-shaped curve, which suggests that a different 20% of the population generates 80% of the aggravation. Stockbrokers, 20% generate 80% of the value. A different 20% generate 80% of the aggravation. And they seem to be equally distributed. But more importantly, I think, is that you can take that good lip or the bad lip, the 20, the do the 80, either way, and you run that lip through the same performance dispersal curve, and performance conformably aligns, which is to say that 20% of the 20 generate 80% of the 80, or 4% of the population base, including 4% of the stockbrokers, generate 65% of the profits. And I learned that in a large population base, that performance dispersal curve probably aligns at least one more time. which is to suggest that 1% of the population generates 40% of the benefit. A different 1% of the population, mostly elected politicians and senior bureaucrats, generate 40% of the aggravation. The brokerage business has oriented itself around selling assets under management without particular regard to the performance that's generated for the customer. Because customers demand to be lied to, just like voters demand to be lied to, the rewards accrue to the best salespeople, not to the best performers.
You know what Warren Buffett said when he was talking to a managed money guy? He said, "How come you guys charge 2 and 20?" And he said, "Because I can't get 3 and 30." It's so true, Rick. I've seen it. It's like I could apply it to a lot of things, but the best salesman wins when they're not judged on merit is kind of what you're saying.
They win in the near term. You know, the best salesman is the first guy to buy a Lamborghini.
The first guy to go broke.
The best analyst is the guy who ends up owning the Lamborghini dealership. So if your goal is to own a Lamborghini as opposed to owning a Lamborghini dealership, then you can be a good salesman. You can churn through customers, customer after customer after customer after customer after customer. To make a difference in your life and to make a difference in society, you have to be a very different human being.
Rick, I know we have a deadline here, but I do want you to talk about your upcoming Rule Investment Symposium, July 7th through 11 in Boca Raton. Please give us an update here.
Actually, I'm going to sell you 3 things. We'll see how good a salesman I am.
Okay.
The first I can't fail at. If your audience likes what I have to say about resource investing, they can personalize it. Go to Rule Investment Media, list your natural resource stocks, and for free, I'll rank them 1 to 10, 1 being best, 10 being worst. Given that it's a free product, it has an absolute money-back guarantee. If for any reason you're not satisfied with my rankings, I'll refund all of the money, which is precisely 0, that I charged you for the rankings. The second product that we have is the Rule Gold Bootcamp, Part 2, this Saturday, where we teach you how to invest in the biggest and the finest gold mining companies, generating alpha in the gold business. Traditionally, this has been a superb investment activity. Gold bull markets are predictable. They're led by the metal. And our first boot camp was all about investing in gold and surrogates for physical gold. When the price momentum is established in physical gold, the next receptacle of the money is the biggest and the best gold stocks. And 13 weeks ago, they started to move in earnest. We are in, I believe, a gold bull market. And the next part of the move is in the biggest and the best. And that's what this symposium is all about. This boot camp is all about. Rule boot camps this coming Saturday. $99, 8 hours of very, very, very hard work. If you're not prepared to work, don't come. If for any reason you think that we haven't earned our $99, full money back guarantee. Understand that recordings will be available for a year. You'll need them, because we're going to give you more information in 8 hours than you can absorb in 8 hours. You're making an investment in a quantum return in this gold bull market. But the final product is the product that I'm always most excited about. The Rule Symposium has gone on for 30 years. It is, I believe, the finest natural resources investment symposium on the planet. For many reasons. We have big picture thinkers, but not journalists. We have David Stockman, who ran the Office of Management and Budget, talking about our budget. Nobody better to do it than somebody from the belly of the beast. We have Nomi Prinz talking about the structure of Wall Street, not as a failed journalist, but rather as a former partner at Goldman Sachs, from the belly of the beast. We have Daniela DiMartino Booth talking about the Fed, not as a journalist, but as a former Fed analyst. You get the picture. We have big picture perspectives from the players. And then we have portfolio managers like John Hathaway and Adrian Day, people who've operated in natural resources for 4 decades, not people who flunked out in pot stocks or flunked out in crypto, but rather people who made money where the rubber meets the road. Every single exhibitor at our conference has been vetted by the conference sponsors to the extent that if we don't own them in our portfolios, they don't appear on the conference floor. No guarantee because Rick Rule owns a stock that the stock goes up. But there is a guarantee that to be on our exhibit floor, you have to be vetted. At every other investment conference I know, the qualification to be an exhibitor is a check that cashes. Not a very tough qualification. And finally, that money-back guarantee. We're going to give you 50 hours of programming, whether you attend live July 7 through 11 in Boca Raton, Florida, or whether you join a couple thousand other people and watch the conference via live stream. You'll have access to the recordings for a year. You'll need them. We're going to give you 50 hours of programming in 4 days, more than you can absorb. So you're going to have to play the tapes. But if for any reason you don't think that we've earned the tuition we charge you, for 30 years, we've had a solid gold money-back guarantee, satisfaction guaranteed or your money refunded. We've had to refund about 1%, 1/10 of 1% of the tuitions that we've charged over 30 years for both the boot camps and the symposium. But it's your guarantee that we're going to deliver value for money, or else you don't pay.
Rick, I appreciate that, and I will put the link to all of those events in the show notes below. I know you have to run, so thanks for coming on Mining Stock Education today.
Always a pleasure. I look forward to another interview when you think the time is appropriate.